This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and we welcome you to the Rocket City Retirement Show with my friend and certified financial planner, also financial advisor, Cris Wallace. Cris is president of WG Financial Group, and then from the firm joining us is certified financial planner, financial advisor, Richard Constantine. So they're both here today to give us some really good advice about retirement planning. As we go through our show today, this is the number that we want you to have handy, 256-937-2010, because that's how you can reach out to Cris with your specific questions. Anything that Cris and Richard bring up today, reach out to them, and you can even text the word visit. We've made that available for you now. Text the word visit 256-937-2010 for a complimentary discovery session. Remember to always check us out on Facebook during the week, WG Financial Group 256. Anything that happens throughout the week, Cris will make updates and also reference our show. So our motto here is plan, retire, and play. That is our dream for you. That is what Cris and his team have a passion for. Find us online anytime at wgfinancialgroup.com. Remember, this show is available on Spotify, Apple Podcasts. Just search Rocket City Retirement Show. And with all of that, now we can get started. I want to say hello to you, Cris.
Hello to you, Luann. Welcome back. How are you feeling?
I'm better. I'm way better now.
You're
yes.
better.
Just a little tired, but better. Yeah.
COVID again?
Hit me again. I think it's the third time. I think I said fourth, but I think it's my third. But no fun. I'm mad about it, actually, but it is still out there.
This is your third time. Was the third time worse?
The first time was worse.
Okay.
Third time would be the next one. And then the one I had in between was just kind of not that big of a deal, but.
Okay. So this one was not quite as bad, but
not as bad, but the fever didn't last as long. Mm-hmm.
Okay. I knew when I talked to you, you still were not feeling well. So
no.
I'm glad you're back.
Thank you.
And still kicking it. So that's good.
I'm glad to be back. And Richard, I want to say hello to you.
Hey.
Sorry.
You know, Luann, my dad actually had COVID last week as well. And it was, the third or fourth time he's had it too.
What is this? I bet he and I are about the same age, huh?
Yeah, probably. And he's had the vaccine, all the boosters, and still getting it. So.
Yeah, it is still out there. I don't think those boosters are doing a thing. Now, I can't say
They're boosting your
I didn't get
ability to get COVID, it seems like.
I didn't get the booster, but I maybe I shouldn't be announcing that out loud or someone's going to come after me, but no.
You're getting canceled.
My family.
Yeah.
So anyway, sorry that I missed last week. So excited to be back with you guys today.
Well, Luann, you didn't miss much because Richard and I tried to record. And as you know, compliance didn't like some of the things that we said. And that's their job is to filter out some of the things that we said. So so that's why there was a rerun again last week because we ended up having to literally scrap the show because of some things that were said. It wasn't bad, but compliance, they're real particular. They don't like things that sound testimonial-like and stuff like that. So they're really, really particular. So, these shows, when we do them, they've got to go through the compliance mill, and the compliance chewed it up last week. And so
chewed it up, spit it out, right?
Yeah, we're going to try this again, 2.0 this week, because we got some of the same topics, but we're going to phrase things a little bit differently so that our friends in compliance will let the show go to the stations.
Yes. Okay.
So Luann, it is your job to keep Cris and I on the right track.
Okay. So I'll reel you back in if you go too far. Okay.
If we go too far, just reel us back in.
Reel you back in. Okay. All right. Very good. Well, let's start off like we always do with the WG positivity. I always love these moments. And Cris, you said you have something.
Yeah, so I'm going to do my best. I'm not going to try to recreate, like I always say, when Graham is not doing these. I don't want to recreate what he does because he actually does a really good job and he sounds so genuine when he does his little positive moments and stuff. But mine is more of a reminder. So we're going into an election season that is going to be crazy. It already is crazy. I mean, if you're plugged into the media and social media, you're seeing what's going on, right? I mean, everybody knows that it's getting a little crazy. there's a big divide between parties. And if you take one side, you hate the other side, vice versa. And just our message at church over the past several weeks has just been kind of like walking in the light and just remembering that, even though you disagree, you can still love somebody. And really, you want to, if you're a Christian and you're trying to lead people to Jesus or whatnot, you do that a lot by your actions, because sometimes what you say and what comes out of your mouth does not replicate what your actions say. And I think that's what made Jesus pretty special when he walked the earth. It was, his behavior. It wasn't necessarily, at least I don't believe it, not necessarily, well, it was what he preached, don't get me wrong, but there's also his behavior and how people gravitated to him, those that were around him and had the opportunity to meet him. And I would just encourage just individuals, whether you're a Christian or not, or whatever religion you are, just remember just to love people, regardless of their beliefs. At the core, we're all human beings. And I think if we can all behave in that fashion, as hard as it is, the world will be a better place. But it's tough, Luann. I mean, I've been on social media quite a bit the last couple of weeks, just checking election numbers, and I can feel my blood pressure go up. And at the end of the day, I just think we have to be kind, loving, forgiving towards other people, regardless of beliefs. So that's my positive reminder.
I like that. Week. Very good. I will say this. I have two sisters. My middle sister and I are best friends, and we totally have the opposite positions politically. So we just don't go there because I love her so much. My other sister, the same. I love her so much. And she'll say things, and I just basically am quiet, and I just don't say much. But I love them. I don't want that conflict. So
yeah, then oddly enough, like if you talk to somebody, you'll find common ground. There may be some major differences in your beliefs, their beliefs, but as humans, we all have common ground. And even if the common ground is we both woke up and had breath today, that's a positive, right? And we can all agree on that.
We're alive.
Right. Exactly. So, just positive reminder to everybody. It's going to get crazy.
I think it's going to get crazier, right? the next several weeks, now that summer's over, here we go.
Oh yeah, it's going to get more crazy when you're done. Yeah, we just
it is. So, all right, we're going to remember
tip of the iceberg right now.
Yeah, we're going to remember that. Okay, everybody, remember what Cris said. Okay, love one another.
Isn't that a song? Indeed. Was that a Beatles song?
Maybe.
Graham would be proud. I think that's a Beatles song. Anyway, if it's not, forgive me. I'm not a Beatles fan. Graham is a huge Beatles fan. He's not here today for me to look over at him.
I can't chime in on that one. So
anyway, we'll move on.
Okay.
Yeah, we'll move
All
on
right. So let's turn to Richard, because he has our current market conditions, and that's something to talk about too right now. Tell us about that.
It is. And so for the first time in a long time, the S&P 500 actually has larger year-to-date gains than the NASDAQ 100. So far, year-to-date, as of Tuesday, September 3rd, 2024, the S&P 500 is up 16.19%. The NASDAQ 100 is up 14.77%. The Dow Jones is up 8.75%, and the aggregate bond index is up 1.35%.
So they're all drawing closer, not including the bonds, but the big three are drawing closer together. The divergence is definitely narrowing there.
That is true. And, this is the conversion, like Cris mentioned, is something that, typically is good for a healthy market. Last week, NVIDIA reported earnings, and although they beat their expectations, the market they did not beat them by enough to excite the market as a whole. And so it'll be interesting to see how these next, few months go, with one, leading up to the election, and two, no more really big companies reporting earnings to provide a catalyst into the marketplace.
Yeah, it was kind of funny last week. I remember I was at the office and Richard's running around the day that NVIDIA was reporting earnings, and he's like a kid running around the office.
It's like Christmas.
He's like, NVIDIA's going to release earnings here in 20 minutes. And so the whole office knew about it. And it's just kind of funny to listen to him do that. So let's talk a little bit about interest rates. So we have a Fed meeting coming up on 9/18. And there's a 100% chance of a rate cut, a rate decrease, really for the first time in 2 years. So that's coming. As of right now, there's a 65% chance of a 25 basis point rate cut, and there's like a 35% chance of a 50 basis point rate cut. So what does all that mean? That means a rate cut's coming. So nothing is showing that they're going to leave rates where they are. And we've seen unemployment numbers trending up. We've seen some, what I would call more favorable CPI numbers come in. I know a lot of people are like, inflation's not down. No, it's not. I mean, that's kind of the really bad part about inflation is the permanent elevation in price that we've talked about a number of times on the show. So it's definitely coming. And we can say that, I would say that rate cuts, or I don't know how you feel about this, Richard, but I would think it should be more positive it's definitely positive for bonds, because falling yields, falling rates is good for bond values. It's bad for bond yields because yields are going to fall. But when it comes to like stocks, it should be positive. And that's assuming that the feds are going to be able to orchestrate a soft landing. And they never have in the past. So spoiler alert, it's never happened, but it should be positive, I would say, long term.
Oh, I agree with that, Chris. And to your point about how the Fed has never really orchestrated a soft landing before, I think people tend to forget that the underlying factors in the economy, such as unemployment, such as inflation, when the Fed has cut interest rates lower in the past, it has always been for the most part, it has always been a knee-jerk reaction downwards, right? We had COVID, we had the housing bubble. We've never had a stair-stepping down interest rate cutting cycle before in a long time.
Yeah.
And so in our belief, the economy as a whole is still a strong, the U.S. economy is still very strong. And so the interest rates being lowered at this time, we are not expecting there to be something that comes up that just causes causes interest rates to go to zero all of a sudden.
Yeah. So in other words, I think we're not expecting a great recession like 2008 type scenario. I mean, we may dip off, a little bit, but all in all, the economy itself appears to be pretty strong. What'll be interesting to kind of track and follow is the housing market and the available homes on the market relative to interest rates and buyers, and just really watching that whole situation, because we know the housing market is a big part of the economy. But I think, just mentioning the housing market, I think the millennials and Gen Z, they got used to seeing really low interest rates. And I just don't know that we're going to see sub-3 interest rates for a really long time.
That'd be nice, wouldn't it, for first-time home buyers? But to your point, Chris, I mean, I think most of Americans, the majority of their net worth is tied up in their home equity. And with how high home values have gone up, at least in the North Alabama area, it's hard to find, typically we saw people who retired, they moved out of their family home and then downsized into either a smaller house or a condo. And even those condos and smaller houses now are more than the price that they paid for their large family home. And so it's going to be interesting, in my opinion, to see how the next 5 years plays out with everyone that we're projecting to retire during that time frame.
Mm-hmm. Speaking of, you're talking about net worth tied up in houses, and it made me think I had to Google search this to make sure I had it pulled up, and I'm going to state it correctly, but I think it was Fidelity. Yeah, it was Fidelity that released a number last week that says there are more, I don't know if you saw this, more 401k millionaires today with at least 1 million in their 401k. So now we're starting to see balances. I mean, if you think about it, it does correlate to the market run really since 2009, to current. But I think it says that there is, as of June, there are roughly 497,000 so-called retirement created millionaires. So that would be, I laughed when I saw that statistic, because you and I know, Richard, that we're like firm believers of having people, put money into their retirement plan. In a lot of cases, we want them to max it out, make sure they're putting in enough money into those retirement plans. But if you watch like TikTok and you see these little videos about people telling you that 401ks are a scam and all of that, because they're all over social media. You've seen them, I've seen them. Some of them are like, buy the IUL life insurance and cash value and 401k is a scam or invest in real estate because 401k is a scam. Here we are. Now, we do know that if the majority of this, we have to assume, and I didn't read through the article to find out if they really broke it down this, to this detail, but we know that the majority of that's going to be pre-taxed money. So
right.
There is some shared ownership there, depending on how much you take out of those accounts. But the reality is there's more money today, more millionaires today than there ever has been in history. So that's a good thing. So I'm not necessarily thinking a 401k is a scam. I think what you have to do is be strategic in how you take money out of the 401k, how you're doing Roth conversion strategies, which, by the way, you need to have the money moved out of the 401k into an IRA to be able to do a Roth conversion. But, just being strategic about that in retirement and really trying to minimize that shared responsibility with our friends at the IRS. And we want to say our friends at the IRS because they are our friends. We have to say that on air that they're our friends because we have to give them some money. And I don't want anybody breathing down my neck. But, all joking aside, you want to utilize the tax code in your to your favor that's legal to really reduce that shared responsibility with them.
Yeah. Well, and Chris, too, like you mentioned, one of the things we recommend to clients is to max out their 401k. Well, as we've seen every year, the 401k, or almost every year, the 401k contribution limits have increased as well. And so, we expect that I expect that this Fidelity study is going to even have more and more millionaires next year and the year following and the year following. But what with that shared responsibility that you mentioned with having the IRS there with you, what you're doing is essentially making the problem there larger too, right? The more pre-tax money you have, the larger the potential problem is. And it is important to have a plan to get that unwound in the most tax efficient way possible.
Yeah, that's exactly right. So in some cases you are exacerbating the problem for sure.
And with that market report, great discussion, guys. I want to give out this phone number again, remind you how you can reach out to Cris and call for a complimentary discovery session. You can call or text this number, 256-937-2010. If you text, just put the word visit in there. And then, the team will get you set up, get you on the calendar to go in and see Cris. Complimentary. Get this discovery session because this is why we do this show. We talk about topics. If you have questions that arise during our show, you can also obviously ask those questions too in that appointment. Remember, WG Financial Group is the website. You can head there, find our show anywhere you get your podcast, Spotify, Apple, wherever. Just search for the Rocket City Retirement Show. Also, Cris has us on Facebook, WG Financial Group 256. Search for that. But we just thank you so much for being here today. You're listening to the Rocket City Retirement Show with my friends Cris Wallace, Richard Constantine of WG Financial Group. Chris and Richard are both certified financial planners and financial advisors. So we are just sharing some wonderful information so you can be in the know as you head into, or maybe you're already in retirement, but that's what the show is all about. So, all right, let's kind of get to what you guys do every day, and that is that you plan retirements with retirees. And these are people who are either heading into retirement 5 years out, maybe people are already in retirement. But, a lot of times we've done this, Cris, so many years, people will make a decision maybe without consulting someone like you, a financial advisors, and maybe they could have had a better turnout on their decision making if only they had worked with a professional like you, right?
Yeah, it helps. It does help to have somebody on your side going over rules, laws, regulations that you need to know about. So yeah, it definitely it's a help.
Okay, so let's kind of get into some of these scenarios that you guys have actually witnessed and been part of and tried to guide people.
Well, we're going to give some examples of some similar type things that we've seen. Yep. So that's what we're going to do, just to make sure that, we're clear on that.
Right. Okay. Yeah. Good point. Good point. The names have been changed to protect the innocent.
It's so true. So very true. We will not mention any names for sure.
So these are types of scenarios you have worked with. Okay. So let's take this first.
Similar types of scenarios that we
Similar types?
Yeah. Similar.
Okay. So here we go. Let's just take a female who's she's divorced. Okay, so she's single now, but she actually had a deceased ex. Okay, so they come in, or she comes in and sees you, and how does the discussion go?
So let me give you an example of some things like this that I've seen before. So let's assume that you're a single female and you come in the office and you sit down with me. You're coming in for your discovery session, and I go through my entire intake sheet, and it's very detailed. So I ask a lot of questions. And an example would be like in this case, if this single female came in and she's got, let's just say she's got 2 ex-husbands.
Okay.
So, and let's assume that one of those ex-husbands is deceased. Okay. So the first thing that, as an advisor, that I'm going to look for is which Social Security claiming strategy should she use. So in this example, if I have a single female coming in with 2 exes, she would actually have 3 different strategies that she could use. She could claim off her own benefit. That's number 1 strategy. A number 2 strategy is that she could claim off the divorced spouse benefits, the divorced living spouse.
Okay.
Or maybe the third option would be to claim off the deceased divorced spouse. She's not married currently. So in this particular case, her best option, depending on her record, her Social Security and her earning record, the best option in a situation that I've seen similar to this one was it was best to claim off the deceased ex-spouse.
And that would probably be because there was going to be more money coming.
Because she's going to get more money because she can utilize his benefit and let it grow to her full retirement age, which would outpace what she could actually get or get from the divorced spouse. So seen situation similar to this. This is why, and here's the kind of the ironic thing, like all of the examples I'm actually going to talk about for the most part today are single, widowed, divorced females.
Okay.
And it just kind of fell like that. I didn't just choose to do that. Once I put the show notes together last week, it was like, oh my gosh, most of these are single, divorced, widowed spouses.
Yeah.
So anyway, in a situation I've seen similar to that, I was able to offer which strategy would work best. And actually, we were also able to increase the overall income because of the claiming strategy. So all of that to say, kind of wrap this up in a nice bow, the claiming strategy that you use with Social Security, whether you're married or divorced or widowed or single, is very important to your financial plan. That Social Security is going to be the base set of money, the base amount of money that's going to come into the household on a guaranteed basis. And it's really important that a lot of thought is actually put into the claiming strategy itself.
Okay. Very good. It's so interesting because these are, things that a lot of us don't think about or don't even know about. Oh, I could claim off of my deceased ex-husband, right? So again, these are things that, people don't know about. And that's why you need to talk to a financial professional who does
Luann,
this.
real quick, and just to toss this in here, I know you're going to bounce a question over to Richard here. I've seen situations like this where someone has been to other advisory firms and they were not even asked these questions. So this is, almost 20 years of experience and training that has allowed me to be able to kind of sniff out some things when I think they're in the best interest of somebody's situation.
Okay. All right. Let's go to another question. Richard, this will be to you. So let's say we have someone who is married. They are in their late 50s and their assets are about 1.7 million. Okay. Pre-tax assets. Would a Roth be worth doing in a situation like this?
Yeah, Luann. So if you are one of those 497,000 401k millionaires that we talked about earlier today, you do have the problem of how to unwind that ball and, pay the IRS and Uncle Sam the least amount as possible, right? And so based on utilizing a few different of our softwares, we have found that clients who are still in their late 50s, and please keep in mind we're projecting these clients to live about 35 years from that point in time, it makes sense to even go up into the 35% tax bracket to still do your Roth conversions. And by doing that, one, you're eliminating taxes in the future with RMDs. You're going to have no risk of potentially busting through your IRMA brackets for Medicare purposes. Because if you're in your late 50s, you can get it all completed before the age of 63. And that is when IRMA looks back on how much to charge you in Medicare premiums. But even by swallowing that huge tax pill up front in the 35% bracket, we have found through the use of our different softwares that it is better for you to Roth convert than to keep all your money in pre-tax funds.
Very good. So do what you can. Diversify. Right?
Yeah. I think you have to kind of look at the potential when you're talking about Roth conversions. I think, first of all, one of the things we would look at, I know Richard and I look at this together, the earlier you can do it, the better, because there is somewhat of a break even to some degree. So after you convert, you pay the taxes. It's like, how long before I make up the taxes? Well, you can't really accurately predict that because you don't know exactly what the market's going to do. But what we can say with what I would call reasonable certainty is that the longer the time horizon is, the more likely you are to make that up before you pass away. And I would say that most have that opportunity, to make up what they paid in taxes. The real benefit from this is if a husband and wife, filing a married joint return today, if one of them goes into the single filer bracket, then those conversions are a godsend at that point, because now you're dealing with Roth money, you're not having to deal with RMDs, and you're in a less tax-friendly single filer bracket, but now you got Roth money. Versus if, say, someone dies at age 78, say both the husband and wife are 78, they've got $2 million in assets. I mean, you're looking at that point, you're looking at a RMD of over 80,000, approaching 100,000. Well, in the single filer bracket, you're going to be right up in the 22. And by the time you add Social Security and maybe a pension into it, you may be creeping up closer to that 24. So the Roth conversions are for both, but also protect the survivor when they fall in that single filer bracket.
Yep, that's exactly right, Chris. Another thing too that people, and I feel like it's an emphasis that I'm making sure that the clients I work with understand, is that by doing Roth conversions, you're also saving your beneficiaries a headache in the future too. Let's say the beneficiary is your child, and the child is working and making a good amount of money. He's in a high paying profession, et cetera. Well, he or she is still going to have to take your RMDs that you were going to take for that 10-year period. Versus if you had just done the Roth the RMDs for that 10-year period, plus at year 10, he's going to have to take a lump sum distribution out of that account. Whereas if these funds were in Roth form, the beneficiary can let them grow for an additional 10 years after the second spouse passes away. Plus, he will receive all of those proceeds tax-free.
Mm-hmm. Yeah, and it does help the kids for sure there. So good points there. So this is good conversation. We've got several other questions, but this is the first half of the show. So if you're catching this 30-minute version on the Ride to Church Sunday, you're going to want to hop out to Spotify or Apple Podcasts and catch the entire episode. If you'd like to give us a call and set up a discovery session, you can do that by calling 256-937-2010. Again, the number's 256-937-2010 to set up your discovery session, and we'll walk through your personal situation, very similar to some of the examples that we're talking about today.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010. 2010.
And Cris, I also want to mention that you and your team are doing lunch and learns, and I want to make sure that everybody knows that if you are the owner, president of a business, maybe you're an HR manager of a business, that Cris, you would welcome the opportunity to go there, hold a lunch and learn for their employees, and this is complimentary for businesses right here in the Huntsville area.
Yep, done it several times. Would love to do it again. Give us a call, 256-937-2010.
Okay. All right. So let's get back to some retirement scenarios and kind of learn from these. Sometimes we can learn from mistakes so that we don't do the same things others do. And just a lot of great information here as we go over these. But Cris, let's take this example here. Single female, and she's contributing to an HSA, okay? Her brother says, hey, it's time for you to sign up for Medicare. I don't know if must be 65 or whatever. So she does. So talk about this and what can happen here.
Okay. So first of all, I've run into situations like this on a number of occasions where either a family member, neighbor, or coworker, those individuals are giving financial advice to another person, and it's the wrong advice, frankly. So let's just take this situation for an example. I may have another one to give you here in just a second. So let's say you were talking to a family member and everybody's terrified of getting the Part B penalty, because if you don't sign up for Part B on time, you get penalized and all of that. And but a lot of people don't know. Well, I say a lot of people. I don't know how many people don't know, but there are people out there that don't know that if you're working for an employer with 20 or more employees and you have health insurance through that employer, you don't have to sign up for Part B. You really don't have to sign up for A as well. You especially should not sign up for A or B if you're contributing to an HSA, because if you sign up for A or B, you have to stop contributing to an HSA. Okay, a lot of people don't know that. So the only time that you really have to sign up for A and B is if you're working for an employer with less than 20 employees. So that is kind of the rule of thumb to keep in mind there. In the situation you're kind of discussing here, I've seen an example where a family member is giving advice to said individual, and I've seen situations where they've had to go back and file amended returns because they signed up for A because they were told by the family member to sign up for A and continue to contribute to an HSA. So I've seen an example where somebody's had to do amended returns, take the money back out, and pay some penalties on top of that. I've also seen situations where when I've done discovery sessions, and I try to be very gentle about how, when I'm talking to somebody, I definitely do not want to come across as arrogant or I know it all, because I know that if I went into some of the offices with some of my engineer clients, they would just whip my tail around the office in terms of knowledge at what they do on a day-to-day basis. So here's another example where I've got a situation, or I've seen a situation where I've had someone come in, they are only putting in enough to take advantage of the employer match, which that's fine. That part of it's fine. I want them to put in more so they can get on that fidelity list, but let's just be it what it is right now. So they're putting in just enough to take advantage of the company match, which is really the first order of operations, if you will, in my book. Take advantage of that company match. So they were doing that. Their modified adjusted gross income was low enough to put into a Roth IRA on the outside. Instead, this individual was putting into an after-tax brokerage account, so a non-IRA, into funds that were generating dividends. Well, you're going to pay capital gains on dividends being paid annually. So instead of putting into the Roth IRA, so if this individual just would have put into the Roth IRA and not into the non-qualified account, they wouldn't have to pay capital gains taxes on the dividends. The other problem is they're buying mutual funds inside of the non-qualified account. So mutual funds can generate something called, we call it kind of like a phantom tax. And what that essentially is the mutual fund manager, near the end of the year, if they've had a really good year, they may go in and clean out some stocks inside that mutual fund. And when they do that, it triggers a tax on the owner of that mutual fund, even though the owner of that mutual fund did not sell the fund. Now, we saw a lot of this in 21 and 22. There's lots of articles out there on this. So individuals foregoing the Roth to put in the capital gains and buying mutual funds. And then I've seen the spouse in previous meetings look over and say, well, that's probably why we had to pay those extra taxes a couple of years ago. And I'm like, yep, probably so. The reason that this person was doing that is because they wanted to have access to the funds. And I totally get that. I totally get it. But what you have to remember is when you're making a Roth IRA contribution, you have access to your contribution where you can pull it back out penalty free. This person didn't know that. So during this meeting, I was able to kind of tell them, hey, these are the rules and this is what you can and can't do. And then I had to find a real gentle way to say, you're giving advice to your neighbor and you're not helping your neighbor.
Oh, yeah.
You know, and it was, I didn't quite say it like that, but it was fairly close. I was gentle because I'm dealing with a husband and wife. And one of the things you never want to do is make someone look dumb in front of their spouse.
Somebody. Yeah.
Yeah. So you never really want to do that, but you also you do have to, I feel an obligation that you come in, you've chosen to spend an hour and a half of your time with me. I want it to be valuable. So sometimes I have to teach you how things work. And then sometimes I think, on this point and this question that you asked me, Luann, I think sometimes people are given advice and they shouldn't. And I think that's the value of having a financial advisor work alongside you that stays immersed in this stuff all the time so that they keep you, on the path of going straight.
Well, Chris, like you said, it's, someone's coming in to spend an hour to an hour and a half of their day with us. And, what I tell almost every single client who I meet with for the first time or prospect for the first time is, even if after this hour and a half meeting, if we part as friends, that's perfectly fine. I just hope that I at least taught you something today.
Right. Yeah, I think that's so important is that the family or individuals that sits down with us learn something from that conversation.
Right. And that's why we're bringing these to the airwaves today, just to share with everybody. So, you can understand, what other people are going through. And again, if you have your own questions, you can certainly give them a call. 256-937-2010 is our phone number. But we're kind of going through some retiree scenarios. And Richard, I have another one for you. And this happens a lot when people, they're in retirement and they have their hard-earned money saved, okay? They have their assets and they think they can only spend a certain amount because they're worried about running out of money. Because the thing is, we all are. We don't know how long we're going to live, and what we have is what we have. So let's say this is a single person, okay, and they're thinking they can only spend about $2,000 a month in retirement. But you guys can say, hey, you can probably spend a little more than you're actually thinking with confidence. Yeah,
no, absolutely, Luann. Part of our job is to provide clarity and confidence to clients. And in this example, or that you're saying that the client thinks he can only spend X, but he could really spend more than that. This happens quite frequently. We also see it on the other end of the spectrum too. We see where clients come in, they think they can spend a lot of money, and in reality, they can only spend about 60% of what they spend. Part of our jobs is to be the guardrails on a bowling lane, for example, and make sure that you don't fall off into the gutter one way or the other. One way being you didn't enjoy your retirement, you didn't enjoy your savings, and you could have spent more. And the other way is running out of money when you're after 10 years into your retirement period.
Yeah, I think, Luann, just so I guess the listener that's just listening to the show, we do a lot of analytical stuff with people's retirement. We actually use two different softwares. So we use a software that's very income driven. And then we use one that is Monte Carlo analysis. And the reason we use two of them is I always say it protects you, protects me. And I say it helps you. And I say protects. I got to be careful. That's probably a compliance word that they'll probably ding me on. So we use two softwares because it gives us a more reasonable confidence number. So let me say it that way.
Yeah.
So, and I'm doing that because you need to sleep at night, but I also need to sleep at night because if I'm going to be working with you on your retirement plan, I have to lay down and be able to sleep at night knowing that I've got your plan laid out properly. And that's exactly how Richard feels as well. So we use two different softwares. We use One is more income driven, and then one that has the more math behind it. And they both obviously have math in them, but one is kind of designed to tell us what's that max number that you can spend today from a confidence standpoint. And so that's helpful, because you may come in and say, to this situation that Richard's talking about, I can only spend $3,000, whatever the number is in retirement, but our models are saying, no, actually you can spend a little bit more than that. And you can do that for the first few years of retirement. And as your retirement moves on, spending will probably decrease. So using those two different softwares really, really helps out. And I think it gives the person or the family that's sitting with us a better and stronger sense of confidence in their retirement plan when we're all done.
Okay, let's take another situation where, Chris, somebody is, let's say, taking too much money from their IRA and putting it in their savings account, and that's going to get taxed. Now, maybe it's an RMD. For some reason, they're taking money out of that IRA and parking into their savings account.
Yeah. So I've seen this a lot. So we, during our working years, it's just ingrained in us to save money. So it's part of it's on our budget. So we spend for groceries, we have taxes, whatever. But there's always a line item. X number of dollars goes into savings. So this becomes a 30-year, maybe in some cases a 40-year habit of saving money. So there have been a number of occasions that I've had to have conversations with people who are wanting to pull out more money. And they say, well, don't worry, I'm just going to put it in savings. And I'm like, wait a minute, that doesn't make any sense, because, if you're wanting to save $1,000 a month, that's $12,000 a year. And if you're in the say you're in the 22% tax bracket, that's an additional $2,640 in federal taxes that you're going to have to pay, just so you can, and I'm doing my little quotations here, quote, tickle the savings part of your brain, when in reality, you should just leave it in the pre-tax status if that's where it's coming from, because there's no taxes on it. And that's still considered, in my opinion, a savings account. So I've seen that a number of times. And so you literally have to pull out the calculator and say, if you do this, it's going to cost you $2,600 in federal tax, because you're in the 22 bracket. So in order for you to quote unquote save money, put it in your savings account, is a $2,600 IRS chunk you're going to give to them. But then you're going to put it in your savings account. And if you're making interest on the money that you have in your savings account, which savings accounts are paying a lot better than they paid in the last 10 years, now you're going to get taxed again on the money in your savings account. So this is a situation I've run into quite a few times where I've had to readjust how people think about making withdrawals. And they say, well, I'm going to use it for travel. Well, great. What if you don't use all of it for travel? Maybe you took the $12,000 extra a year and you only used $6,000. So $6,000 sits in the savings account. Well, now you're $1,300 to the IRS. My advice is pay for your trips as you go, and not pull that money out till you're going to use it, because once you pull it out, you're going to pay taxes on it.
So Chris, I have a question for you. How do you feel about, let's say one spouse is still working, but one spouse is retired? How do you feel about the spouse who is still working, still contributing to his or her 401k, and the retired spouse pulling money out of his or her IRA?
Oh man, I don't like it, because I think you're basically increasing your overall tax liability. So I think you got to figure out how to make it work within your net income of the working spouse, if at all possible.
Right. Well, and it's something that I came across recently, and the working spouse was contributing the max to her 401k, and the retired spouse was pulling out about $500 a month from his IRA. And they share a bank account. It's not like they have their finances separated. And it just trying to articulate how this was just creating the problem worse did not come across easily.
Yeah, no, I know it doesn't. It's a delicate conversation, because I think there's that, I guess that mentality as it's my IRA, and I'm going to pull my money out and I'm going to start spending my retirement. But in a situation like you just described, surface level, looking at it from high level, it's like I wouldn't touch the IRA, and I'd figure out how to make it work within the net income of the working spouse.
Right. Even if it's lowering the working spouse's 401k contributions.
Yeah, that's what I was going to ask. Yeah, that's what they should do, right? Instead.
Right. No, you're exactly right, Luann. But people tend to be ingrained into habits that they have developed over many years. And one of their habits was maxing out their 401k. And it got them to the position that they're in now, which is a good position. But it's not always about accumulating as much as you possibly can when it's adversely affecting your overall picture.
Wow. This is a great topic to talk about. Interesting. Okay. I have another one for you. Richard, this is going to be to you. So many retirees want to know, hey, should I try to pay down my mortgage before I retire? What should I do? I know you guys get those questions all the time. And I think every single answer is different depending on the individual. But let's take a client wanting to pay down that mortgage, and they're asking you, where should I take from where should I take my funds?
Yeah, no, and that answer is different for every single person. Some people that have a very large mortgage balance and all of their assets are in the pre-tax category, that's more times than not, they are not going to get the answer that they necessarily want to hear. The cost benefit of paying off the mortgage versus paying a huge amount in taxes because they're going up in higher income brackets, it just isn't worth the effort of doing so. And so the answer is going to be different for every client, but at the end of the day, there is typically a way that we can get to the same end result that the client wants, whether it's taking it out a year or two extra. But knowing this information is incredibly pertinent when we're discussing a full financial plan with someone. Is what are their liabilities and how quickly is it important to them to get out of those liabilities? Because we can always give you the math answer that of how you're going to have the most amount of assets and also future assets too when you include growth. But the answer that is not quantifiable is the emotional cost to them of how important it is to get out of debt.
Right. Okay. Very good. So again, if you have a question, if you have this exact question and you're wondering what to do, then here's the phone number. Okay. 256-937-2010. That's the way to reach out to Cris for a complimentary discovery session. Get your questions answered. Again, you could text the word visit to 256-937-2010. If you like to text, we're making it easy on you. You can do it that way, and they'll get back with you. You just do a little text back and forth and get scheduled for a complimentary discovery session. Remember, you can find us online at wgfinancialgroup.com. And also, if you ever want to listen back to any of these shows, if you didn't catch the whole thing, you want to listen from the top of the show, just look for the Rocket City Retirement Show wherever you get Spotify or on an Apple podcast or whatever. Just search for the Rocket City Retirement Show. We thank you so much for joining us. This is the Rocket City Retirement Show with Cris Wallace and Richard Constantine of WG Financial Group. Both are certified financial planners and financial advisors. So, all right, let's get on to the next question, or I should say scenario, what we're doing today on our show. It's kind of fun looking at different scenarios.
Different scenarios that we may have or may not have seen similar.
Yeah, but okay, how about this one where... again, you're working with a widowed female. Let's say she's receiving about $1,700 from an annuity, and that had been set up via some type of Medicaid planning before her husband passed. Tell us about that and what you could help her with.
Yeah, so I've seen a situation similar to this where a widowed female came into the office, husband recently passed, and they did some Medicaid planning where they set up an annuity with her funds, and she was receiving $1,700 a month. So now, I mentioned plenty of times on the show, but we actually talked about on this show, where eventually you're going to go into that single filer bracket. So your taxes are going to get a little bit worse, especially if you have more income coming in or similar types of income coming in. So in a situation that I've seen similar to this, we had $1,700 a month coming in, and she was going to get hit with that tax at the end of the year. So no other adjustments were made. So all of this income just coming in. She's still working. So, we're making money as an individual. And now all of a sudden I got $1,700 extra per month coming in that's going to be taxed at ordinary income tax rates. So one of the things that I mentioned to this person was, hey, let's just increase the 401k contributions to offset the income. And that'll do the same thing. So you got $1,700 going in, but we're going to stick $1,700 back in the 401k pre-tax to offset the income. And that was just something that, I happened to work with someone on. And to be honest, if, she hadn't stopped by the office and did a discovery session, then that $1,700 would just be coming in and she would owe a tremendous amount of tax the following year because there was no adjustments made, at least from my discovery session, to withholdings or anything like that. So had she not come in and at least had a conversation so I could talk to her about her situation, then there would have been a nice little surprise come tax season the following year when she finished her return. But I think we were able to kind of nip that in the bud, hopefully.
Yeah.
In a situation very similar to this one.
Right. Very good. A lot of times when people get into retirement, they're like, these are my golden years and there's stuff I still want to do to my house and all of that. Richard, let's say a client comes to you and is interested in remodeling some part of their house. How would you advise them on which assets to use?
That's a great question, Luann. And I think it all goes back to what tax qualifications of buckets of money do they have? If it's all pre-tax money, there are somewhat limited options, but still probably the most favorable option is to even take out a HELOC, even at these elevated rates, because of the income tax consequences that you'll have if you pay out for a huge home remodel. And when I say huge, I don't mean 20 to 50,000. I mean a large project that's going to cost between 250 or 1,000 or more.
Oh, wow.
Right. So
Okay.
it's it depends on the cost, but let's say it was the large remodel. We don't want to take it all out of the pre-tax bucket because of the few reasons that I talked about previously, such as income tax and potentially higher Medicare costs. If they have access to an after-tax bucket of money, such as a joint account or an individual brokerage account, what you can look at doing is either one, selling some positions in that account, paying the capital gains on that account, and then using that to pay off your home remodel. But what if the account has grown substantially throughout time and you still want to be invested in the market? Well, there are a few options where you can actually use your joint account or your individual account as essentially the collateral for the loan. So like with a HELOC, you use your house as the collateral. With this type of lending, you are utilizing your joint or individual account as the collateral. What typically you see in those situations is that by utilizing your joint or individual account instead of your house, one, you're going to save money on the loan origination because you don't have to get your house retitled. You don't have to get it appraised. Fidelity does the appraising for your joint account or individual account daily.
If it's Fidelity, right? I mean, there's other custodians too, right?
Correct.
Yeah.
Correct. If your account's at Fidelity, they do the appraising daily. You also tend to get your funds a lot quicker. Typically, you have access to the cash from the loan within 24 to 48 hours versus waiting a couple of weeks for everything to go through with the HELOC. But to answer your question, Luann, how do we advise where to take the money from? It all goes back to what kind of tax qualifications regarding their buckets of money are.
Mm-hmm. Very interesting. Okay, very good. Not much time left. I'll try to get two more questions in or scenarios in. Cris, how about this one where one spouse is taking Social Security and then the other one is still working? Talk about that impact, please.
Mm-hmm. And this is, I think we've touched on this actually when I put these notes together. Richard and I were kind of working together to do this. I thought it would just be good as a reminder where if you're working, let's just say the husband is a higher income earner and he's still working. Let's say he's, 3 years older in this case. And So he's continuing to work. And then the younger, less earning spouse gets to 62. All right. Now we know at 62, that's the earliest we can take Social Security unless we're a widow or a widower. So at 62, the decision that I've seen made before is that lesser earning spouse will go ahead and they will collect Social Security. Now, what this does, it does a couple of things. Number one, it stops the growth on Social Security. So again, even if it's only a few $100, even if it's like $700 or $800, you're still stopping the growth of payment that you would get in the future. So that's one thing that happens there. So we stop the growth. Let's assume that let's just say it's $1,000 a month, just to keep the numbers easy. So that's $12,000 more dollars per year that you have to put on your tax return that is then going to be taxed at 85%. So 85% of that Social Security amount is going to be subject to tax because I'm going to assume that the higher income earner is continuing to work and he or she's making, say, north of $100,000. So the situations I've seen before, I would tell somebody if they came in to see me is, well, I understand that you want to collect. And a lot of the argument, and it's not really an argument, but a lot of the reasoning and the rationale behind the collecting the lower earning Social Security while someone's still working is, well, it's their money and it's not a lot of money anyway. Well, depending on the salary of the working spouse, when you add $12,000 of Social Security income to a return, it may cost them an extra $1,700 to $2,000 in taxes, depending on how much the working spouse is actually earning. So I think you have to put some thought into whether or not you want to actually claim that Social Security, because one, you stop the growth. Number two, that $12,000 is now going to be subject to up to 85% of it's going to be taxed. And then what I might look at, so let's just say it's me and my wife using this example. Maybe I might, if my wife's is $1,000 a month, maybe I might try to give her $1,000 out of my net income. That way I could just defer her Social Security for a little bit longer and not have to incur the tax on it, and maybe just like feed her money out of savings at that point to continue the growth, and then also to watch the taxes, right? To be a little bit more tax efficient. That's probably the way that I would actually think about doing it. The other thing here to think about is, I know a lot of people say, well, I'm going to get, she's going to get half of mine, and that's not always the case either. So if you start early, you're not going to get the true half. And what I'm talking about here is, we know if we have a higher earning spouse and a lesser earning spouse, if the higher earning spouse claims at full retirement age, and so does the lesser earning spouse, then they are eligible for some additional spousal, which essentially be, when you add that person's and the spousal together, will be essentially, half of what the higher earning spouse is. So when you claim early, you also ruin that part of it as well, because you don't quite get half. Okay. So Social Security, I mentioned it before, big deal. Needs to be a big decision, thoughtful decision, because it can cost you thousands, if not hundreds of thousands of dollars potentially in retirement. So you need to put a lot of thought into that, because that is going to be your base income. So, Luann, that is all we got for the show today.
I know it. So, wow, that went fast. It was fun, though.
Hoping everything comes out smooth here, and we'll see. And so thanks for being back, Luann. I'm glad you're feeling better. Thanks for Richard being here as well. I'll give our number out, 256-937-2010. If you would like to set up a discovery session, please give us a call, 256-937-2010. I hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
AE Wealth Management, LLC provides services without regard to religious affiliation, and the views of individual advisors are not necessarily the views of AE Wealth Management.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.